Before we begin this podcast, we'd like to remind listeners that Netwealth is licensed to provide general financial product advice only, and that this podcast isn't tailored to any particular person's objectives, financial situation, or needs. Before a listener acts on any advice in this podcast, they need to think about whether it's appropriate for their circumstances or their clients, and consider the product disclosure statement for any proposed investment, and also seek any professional advice they need. Netwealth Investments Limited is the issuer of Netwealth's financial products. For Netwealth's financial services guide, contact details, and other information about our products and services, you can visit our website at netwealth.com.au. Today's podcast guest is a financial product issuer. Netwealth and the guest have a commercial arrangement that enables investment in products managed by the guest through Netwealth's platform. Under that arrangement, Netwealth may receive fees from the podcast guest. More information about the fees Netwealth receives is provided in our financial services guide, which is available on our website or by contacting us. Welcome to the Netwealth Portfolio Construction Podcast, brought to you by the Netwealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.
Welcome to the Netwealth Portfolio Construction Podcast series. My name is Paul O'Connor and I'm the Head of Investment Management and Research for Netwealth, and in my role here, I'm responsible to manage and govern the investments that we make available on the Netwealth investment platforms. Today we have Roger Montgomery, Founder and Chief Investment Officer of Montgomery Investment Management. Welcome, Roger.
Great to be with you, Paul.
Montgomery have a number of funds available on the Netwealth platform covering both Australian and international shares. But I thought specifically, because you're probably better known as an Australian equities investor, that I'd focus on the Australian economy and also a little bit about positioning currently in your Australian equities funds. Starting at a macroeconomic level, we've got many commentators in the market saying that we're late economic cycle and they're expecting GDP to moderate, which will then have the flow-on effect to corporate earnings potentially and moderating share prices. Do you have a view or thought on where we're at in the economic cycle?
I think that's a really diplomatic assessment of where we are in the economic cycle. I actually would go so far as to say I think we've entered a period of deleveraging. So that's where credit growth grows much more slowly than GDP. And so we thought the economy would slow even before the RBA downgraded their expectations for growth from 3.5% to 3.25%. They've subsequently reduced it to 2.75%. So it's falling. The economy isn't going backwards, it's just growing at a slower rate. So we're definitely we're past peak growth. We're now growing at a slowing rate. If I was to put some sort of, I guess, some potential catalysts for something worse in there, a Minsky moment in China, which is what Kenneth Rogoff talked about at the World Economic Forum in Davos in Switzerland earlier this year. If they collapsed under the weight of their debt, and they are slowing at a rapid rate of knots over there, if they did collapse, that would be terrible for us because obviously 30% of our exports go to China, and we can least afford that to happen at the moment because we are in this deleveraging phase. Another potential trigger is further and more rapid declines in house prices. I do think we're going to have further declines in house prices. Whether they're more rapid or not, I don't know. What we've got is a period where people are looking now to or jumping at shadows if we have any sort of a black swan event or any surprise downside announcement of any description. When the market's going well and the economy's going well and property prices are going up, people don't worry about their debt. They look to the future and they think everything's rosy. But now what's happening is property prices are falling significantly, so attention is focused on the debt. And when attention is focused on the debt, it's not focused on spending money. And surprise, surprise, we saw in the yearly results of Beacon Lighting and JB Hi-Fi and Nick Scali, the companies were saying that January was softer and that the weakness was accelerating, or they said it was so dynamic and so volatile they weren't willing to give a forecast. Those things tell me that there is a risk of a recession, but that risk might be 20% or 25%, up from probably 10 or 15% last year. I don't think we're going to have a recession, but if we do, that would mean that we're going to see cheaper bank share prices, for example, which would be great. We're positioned defensively. We're positioned to take advantage of lower prices. So I'm not saying I want a recession, but I definitely want more volatility because that delivers lower prices at times.
That worst case scenario, or the biggest chance of a recession occurring, am I right in saying that I guess China will be the greatest driver and impact on the Australian economy, in your view?
Well, maybe not. I mean, you can have a deleveraging that doesn't come with a crisis, which is what I think we've got. So you can have a deleveraging where the deleveraging lasts a long time and people simply pay off their debt as they earn money. The way to obviously shorten that is for salaries to go up. I don't think salaries are going up in Australia. I don't think wages are increasing. I think wages will be under pressure. I know, for example, that Mercedes-Benz recorded in November a 43% decline in year-on-year sales.
Yeah, I have noticed car sales are
dropping.
Sales weakening. There are warning lights all out there.
Yeah, so that means that potentially raises the prospects of job losses. So wages aren't going to go up. I think, if anything, we're at full employment now, and unemployment, if anything, could go up. Which means the pressure on wages will be less, and so wages aren't going up. So I do think that we have a deleveraging where one of two things happen: people just pay it off, they keep their jobs, and they just pay off the debt, and that takes a while to occur. Within that period, however long that lasts, if China does have a Minsky moment, if it does slow down very, very rapidly, then that could push us into a recession. The alternative is that we get much more rapid declines in house prices and people deleverage by selling assets. If that happens, that could push us into a recession as well.
And I guess that would be in an environment where you've got very benign inflation, and the central banks in a deleveraging environment would also like a bit of inflation going through to try and inflate your way a little bit out of the debt position.
And if you're not able to inflate your way out of the debt, and nobody has been able, Europe's in a recession now. Germany, France is slowing down at a rapid rate of knots. So we're seeing these countries slow down. I don't think anyone's going to inflate their way out of any debt issues that they've got, and so the risk is, I think, the other way. We saw the Fed, for example, back away in January from its rate hikes. So the pressure is, there's no expectation that inflation's going to emerge. Otherwise, the Fed would continue to raise rates. I think they're backing off from that.
Something very prevalent to the listeners would be the comments you've already made there about, I guess, a little bit bearish or cautious on your outlook for residential property. Have you got any more insights into the thinking over the short to medium term? And particularly, we've seen a lot in the media around Sydney residential property, Melbourne residential property coming off. I think anecdotally, evidence that I've seen is that it could be down by as much as 20%. Have you got any further thoughts behind the specific property market?
So we, as you know, the last time I was here for Net Wealth for the webinar last year, I said cash is king. I gave a presentation along those lines, and I specifically alerted people to the property market from 2016 to now. On our blog with Tiki on the ABC, been warning people about property falling. I'm not surprised that it's falling. We expected it. We forecast it. I now think that it's going to fall further. I was interested to see some analysts saying they expected declines for another couple of months. I thought that was way too precise. I don't think you can be that precise. I don't think so. So let's look at some stats very quickly. Who buys property? You've got domestic buyers. Okay, domestic buyers, the rug's been pulled out from under them. We know that interest-only loans per quarter have declined from $32 or $34 billion a quarter back in March 17 to about $12 billion today. So that's a 2/3 drop. So their interest only tends to be the style of loan taken out by an investor. So we know the investors aren't in the market now. Foreign, that's domestic buyers. When we look at domestic buyers who aren't investors, well, we know that house sales, new house sales, are down at 17-year lows now. Monthly new house sales, 17-year lows. We're back to where we were in 2001. I saw Villa World's results come out. I saw AV Jennings results come out. Villa World sold 444 lots in the first half. That compares to the previous half, so the second half of 2018, of over 900 lots. So they're selling less houses. AV Jennings reported sales down, revenue down 40%, and NPAT down 90%. They're selling less houses. So if you're selling less houses, that's less domestic people buying places to live. So there's less interest-only loans, there's less investors. We know the proportion of all mortgages taken out by investors has fallen from something like 54% to about 41% just in the last few quarters. So you're taking out investors, you're taking out only interest-only buyers, you're taking out home owner-occupiers, and what we know the big one is foreign buyers. So FIRB applications back in 2015, 2016, $72 billion. 2016, 2017 dropped to $23 billion. 2017, 2018, the data just came out today, down to $12 billion. So you've seen a drop in foreign buyers.
That's probably more of a normalisation.
No, it's lower than for many years before.
Yeah, interesting.
Yeah, so what you've seen is a pullback for domestic investors, domestic owner-occupiers, and foreign investors, and foreign owner-occupiers. So that's new and established housing. So you take the rug out from buyers, and then you increase the supply of property. So we know listings in Sydney and Melbourne and Canberra, for example, are all up between 20 and 40%. So you increase the supply and you reduce demand, prices can only go one way. So
Economics 101,
So we're still in that phase. So I think we're going to see further falls in property prices.
Yeah, interesting there. So I think a key outtake is the caution around the Australian household because of the falling wealth and the falling savings rate as well across the sector there. Turning our attention to the ASX, I guess the weakening property is going to have a knock-on effect on sectors like the Australian banks. What's your view at the moment on the Australian banks? And in terms of your portfolios, do you have an overweight or an underweight compared to the index on the bank exposure?
So let's just talk about the index. So the index is the ASX 200 is 27% weighted to the big four banks. Total financials make up 4% of the S&P 500. So we have a really bizarre index in Australia where, almost a third of the index is for financial institutions. We've also, as an aside, got 17% weighting in our Australian index to materials, whereas in the S&P 500, it's about 2% to materials. So we do have a unique weighting in Australia.
It doesn't sound very diversified.
It doesn't sound very diverse at all. So fundamentally, we're always going to be less weighted to the banks than the index. We have about 10% portfolio weighting to the banks, and we've picked Westpac and NAB at the moment. NAB because we think it's the cheapest, purely on valuation grounds.
Which I guess is true to the way you've always invested money.
Yeah, we did own the Commonwealth Bank, and we sold it prior to the sell-off in the banks. And then after the sell-off, we bought the NAB because it was the cheapest. What do we think about the NAB? Well, the NAB is least exposed to a mortgage. It's got, relatively speaking, the smallest proportion exposure to mortgages, but relatively speaking, a greater proportion of loans to business, corporates and SMEs. So it's, I guess, more sensitive to the economics and the economic conditions. So if the economy muddles through, NAB looks like a good investment because it's the cheapest. But if we do have a recession, then the NAB would be the worst one probably to own. Having said that, though,
pending residential property and how that occurs.
If we have a no recession and really bad residential property, then the Commonwealth Bank is most exposed. And so that's our thesis and why we don't own the Commonwealth Bank. I should say this though: if there's no recession, the banks are fair value. Okay, roughly in aggregate. If we have a recession, then you could expect share prices to fall another 30 or 40% if we had a recession. I'm not predicting a recession. I think there's a 20% chance. Banks aren't the only ones, though, that are exposed to property. They're your first-order exposures, I guess, and the builders and developers are your first-order exposures. But your second-order exposures are your retailers, particularly, let's say, Harvey Norman, Nick Scali, for example. Anthony Scali, post the half-yearly results, told analysts at a Macquarie briefing that he's going to be maintaining prices rather than maintaining volumes, so that when we come out the other side, inverted commas, the other side of what? Obviously, they know that what I'm saying is fundamentally right, that they want to preserve or maintain or protect their brand value and keep their brand value intact. And so that suggests that those guys believe things are going to slow down. And why? Well, we know that there's a 10-month lag between a house being purchased and it being renovated. We also know, as I mentioned earlier, new house sales, and A.V. Jennings and Villa World talked about this as well, but as I mentioned earlier, new house sales are now at 17-year lows. That's less houses being furnished. It takes about 6 months to fully furnish a house after it's bought new. People sort of take time till they buy the couches and the beds and furnishings and drapes and whatever. So it's going to affect companies like Adairs. It's going to affect companies like, I mentioned Nick Scali, Beacon Lighting. Those companies are going to be adversely affected. They're already slowing down, and they slowed down faster in December than earlier in the half year. They slowed down. If they didn't slow down in December, they reported slowing in January. And some of them came out and said, look, it's so unpredictable and so volatile, we can't even give guidance. So these are the second order companies. And then the third order companies are financial consumer finance companies, the Afterpays of the world. If people are spending less money at the shops because they're focusing on their debt, they want to keep the roof over their head, they don't want to lose their home, but they've got a big debt now and it matters, then they're going to be spending less at the shops. And that's going to affect, the Afterpays of the world and the consumer finance businesses as well.
Interesting. And I guess, a key takeout I got from your comments there, Roger, was a number of companies not prepared to give guidance.
Yeah, indeed. That seems to be a theme from reporting season.
A bell is ringing there in my mind about where we're at in the economy.
Before we bring you the second part of this chat, a little bit about who we are. Netwealth is an ASX-listed company established to help Australians take control of their financial futures. With a wide range of super and investment accounts, a huge variety of investment options and market-leading online tools, we can help you manage your wealth your way. Partner with us to see wealth differently and discover a brighter future. Visit the Netwealth website to learn more and get the PDS, which you should read before making a decision. Products issued by Netwealth Investments Limited.
Covering property and banks, we get to the other investment opportunity in the Australian share market, being minerals and energy.
Yes.
What's your view on the minerals and energy? And, maybe not necessarily all about BHP and Rio.
Sure.
But,
I have a very simple view. It's impossible to forecast commodity prices consistently. I've called the iron ore price once right, and it was a big call, and it was back in sort of 2010, 2011. We thought the iron ore would eventually be oversupplied and the price would drop, and that happened. But trying to predict commodity prices is like trying to predict the currency. It's pretty hard. Occasionally it's obvious. But it's not obvious to me. And because it's not obvious to me, it's very hard for me to value resource companies and materials companies. It's interesting, if you look at a chart of BHP and Rio over the last 10 years, they're not much higher than where they were 7 or 10 years ago. In fact, they're probably not higher at all. What does that tell you? It tells you they're cyclical businesses, and you have to get the cycle right to make a sound investment in those businesses. And getting the cycle right is more luck than science. You really have to be able to predict accurately the commodity price. I'm just no good at doing that. So we tend not to invest in those businesses for that reason.
The takeout again that I would have from your comments is that a lot of our mineral and energy companies are price takers because of the whole commodity issue there.
So we think quality is defined by the ability to generate a high rate of return on incremental capital. To be able to sustain that, you need a competitive advantage. The most valuable competitive advantage is the ability to raise prices, even in the face of excess supply. Now, there's no way BHP can raise its price of iron ore above the market price. If it tried to do that, its volume would go to zero. So we think that, that companies like that don't have the characteristics that we're looking for. That would define them as a high quality business. We think BHP and Rio are high quality businesses in their space, There's no doubt about that. They've got long mine lives, they've got great reputations, they're geographically diverse, they're conveniently located for shipping and so forth. So we think all of that is great. But, if you'd put $100,000 into BHP between 7 and 10 years ago, you've got some dividends, but you've still got about $100,000. You put $100,000 into REA Group 10 years ago, you've got a couple of $1 million.
Yeah, interesting there. And as you're explaining your views there, Roger, I'm thinking to myself, it very much is a tenet of the investment philosophy of Montgomery again,
Indeed.
the quality and the value. And
Correct.
I guess that was a good example around quality and how you look at quality there. So ultimately, I guess we're reasonably bearish on house prices, on banks, on minerals, energy.
I'm not reasonably bearish. I am bearish.
You
on
are
house
bearish.
prices. Having said that, though, let me say this. If you were buying, let me say this, and let me be very clear about this. I'm bearish because I'm excited about the opportunities for buying at cheap prices. The lower the price you pay, the higher your return. So I'm bullish on future returns from property. I'm bearish on their prices in the short term, but very bullish on future returns in the long term. You will do very well if you can buy at a very cheap price property over the next 2 years. If you can call a developer who's struggling to sell a couple of lots, offer 30% below what they want, and they hit you, and you get that property, you bought it at a crashed price, you're going to get a great return out of that over the next 15 or 20 years.
It's a key point, it really is, because I guess in our lives, maybe over every decade, we get 1 or 2 or 3 of these opportunities.
Yes.
And so I guess this then leads into your portfolio positioning. And I guess, again, you've circumvented one of my questions, which is around your cash weighting. And I'm assuming you have a significant cash weighting in your core Australian equity strategy.
We did prior to the sell-off that started in October last year. You might remember the markets declined considerably between October and Christmas Eve. Prior to that, we had about 22% cash, 22 to 23% cash. That's as the market fell during that quarter, during the last quarter of calendar 18, we deployed that cash. So we're now at about 13% cash. So we've deployed about 10% of our cash. Once the market started rallying again in January and the early part of February, we've stopped buying. The value wasn't there, so we've held off. But now in reporting season, we're seeing some great opportunities in good quality businesses that are falling in price. They just haven't fallen enough yet for us to buy them. We've seen Cochlear come off. We've seen CSL come off. Some lower quality businesses have come off slightly. Still high quality, but at the lower band. Things like Blackmores, for example, has come off considerably. We saw Bingo Industries, which I think has very bright long-term prospects. If you can get your head around management strategy and ask questions about management and their long-term strategy, if you can get your head around that, it'll be making more money in 5 or 10 years' time, but it's going to go through the valley of the shadow of death first. So I'm excited about opportunities in the market at the moment.
Any particular growth themes that you're seeing starting to play out in the Australian economy and on the ASX?
Look, I think there's a bunch of companies in Australia. I think the theme that's most interesting to us at the moment are overseas earners. Given our scenario that I painted in Australia at the moment, I think there's going to be pressure on the Australian dollar. That suggests to me that companies, and I might get that wrong, by the way, I'm no good at forecasting currencies, but I think there'll be some pressure on the Aussie dollar relative, for example, to the US dollar. If that's the case, then overseas earners are going to be more valuable, companies that are earning money from growth overseas. So that puts a couple of companies immediately in the spotlight for me, and 2 companies that we own, Reliance Worldwide, which owns the SharkBite Click to Connect plumbing and gas fitting products. They're growing at a great rate of knots overseas, growing at double-digit rates in the United States, and they've bought another company in London, in England. Some who believe that the UK won't grow as fast as the US is growing, so the focus should be on SharkBite. But there's one example. Another company that comes to mind, IDP Education, another company we own. It's one of the co-owners of the IELTS test, which is the International English Language Testing. So if you want to get a job or study in Australia or the United States or the UK or somewhere where English is spoken, you got to do an IELTS test. If you want to become a citizen, You got to be doing the IELTS test, and so it's not cheap. And they own the rights to that test globally. We also know in Asia there is a growing universe of people, a growing cohort of people who want to be educated in the Western world, in the Western system. And so guess what? These guys have great pathways into universities all around the world, and they conduct those pathways. And they also have Hot Courses, which is a very popular website globally, and that generates leads for them. So they've got a long runway of growth, and they're earning money overseas again, growing at double-digit rates. And then companies that we don't own but we're watching that are growing, that the share prices are a bit expensive, I think, but things like A2 Milk, Appen, Altium, Afterpay, Wise Tech Global. There's businesses out there that are some of them are frighteningly expensive and not a value investment, but they're growing overseas. And so we're keeping an eye on those. I think that's a good theme.
Yeah, and interesting, I guess it's a case of if it hits you or ticks your quality filter, passes your quality filter, you've then got to be patient as a value investor, then waiting for the right entry point and price to buy it.
And the market is very reliable at delivering high-quality businesses at cheap prices. People often say, no, you'll never get them cheap. High quality is always recognised. Well, invariably what happens is even a high-quality business falls on temporary bad times. What the market does is usually treat that temporary bad time as something permanent, so it overreacts on the downside. That gives you opportunity.
Interesting. Very, very much so, your comments there. And I guess it was only the other day I was looking into the issue that because Australia's now interest rate differential with the US, and effectively we have a lower interest rate, but historically we've had to attract capital from offshore, and thinking how that will play out. So very interesting, your comments around how you're thinking around currency and the potential opportunities there around currency. And I think, again, for the listener, a good takeout is that whilst an outlook may be might be bearish, it might be bullish, with that volatility typically creates opportunity. And I think, Roger, you've done a good job in highlighting the opportunity there.
Yeah,
Thank you.
I think that's always the case. It's just vital to remember that there will always be opportunities, and you've got to take them when they come. You'll invariably be wrong if you think the market's going to rally or it's going to crash. That doesn't matter. What matters is this a good business with bright prospects, and is it cheap? And if it is, take advantage of it.
And perhaps finally for our listeners, can you provide us with one or two of your own investment rules or beliefs that you've developed over the years, either through your own personal investments or through the fact of your, I guess, long career in investment management?
So the first one that pops into my head is a phrase I was taught when I was at BT many, many years ago. This is in the early 90s. If you want it, own it. In other words, after you've done all the work and all the due diligence, if you believe it's a good quality investment, it's a great business or it's a great property or whatever, and provided you've done the work, that's the caveat, you're not guessing, you've done the work, then don't hold off because it's $100 too expensive or the share price is a cent more than what you want to pay. You just own it. So that's the first one.
I think a lot of us in the past have looked at things we've wanted, we haven't made that decision to buy, and we've had buyer regret for not.
Yeah, indeed. Buyer remorse.
Buyer remorse.
Yeah. Or missed buyer remorse. And then the second one is probably a bit more complicated, and that is to develop a set of rules or a philosophy for yourself that you stick to consistently. Most people don't have their own philosophy for investing. Some people do, but most don't. They tend to be opportunistic. And so they try this and they try that, and they're led astray. They go off to, charting courses, or then they go and do, a foreign currency thing or a CFD thing or, Bitcoin, whatever, and you end up not only losing money, which is inevitable if you do that, but you end up never learning anything from the experience because you keep jumping and chopping and changing. So it's better that before you do any investing, that you formulate a philosophy and you say, this is my stake in the sand. This is what I'm going to stand for. This is how I'm going to invest. And for me, it's quality, prospects, and value. They're the three things. Is it good quality? Does it have bright prospects? And is it cheap? So I looked, for example, at a private equity investment last year where a company was looking to raise money to develop an autonomous vehicle. And arguably, they are the leaders globally in that technology. They are actually doing better than Waymo, better than many other companies that are trying to develop autonomous driving technology. Some very big names have invested in the company. Bill Gates is in there. There's and I was invited to invest. And I asked myself, is it quality? Well, I think management is good quality. It earns no money. It hasn't got a product yet, so I can't work out the value. So that's a problem. But I could tell very clearly that at a multi-billion-dollar valuation, it was too expensive for me. And so it didn't tick really. I think the prospects are really bright, and that was it. So it really only ticked one of my three boxes, and so I couldn't invest, so I didn't. So that's an example, and I might miss out. It might make a lot of money, and it might sell for hundreds of billions of dollars in the future. I don't know. But what I do know is that if I get it wrong, I've learnt something. I can go back to my philosophy and check it and revise it and massage it and change it and then try it again. But if I didn't have a philosophy and I just yes to that and no to that, I'm not going to learn anything. I did say at the start, this is a little bit more complicated, so it is. And there's lots of places you can go to learn investment philosophy and investment techniques and methods. Our book, I hope you don't mind me saying, but the book that I wrote, Valuable, is one of those. But you've got to have that first. So that's really important.
Very much resonates with me when I'm looking at fund managers and funds that we're going to make available on the NetWealth platform. We don't make everything available, but I want to see a clear investment philosophy that I can understand. And then you like to see that actually embedded in the investment process. But I think that is not only the domain of investment managers, it's the domain of everyone.
Well, if you're
in how you invest.
Correct. And if you're investing your own money, you are your investment manager. So you need a philosophy too.
So on that note, I will end the podcast. But again,
fantastic.
Thank you very much there, Roger, for
Always
joining
a pleasure
us.
to be with
It's been
you.
very insightful and good fun having the conversation. So thank you very much, listeners. And we look forward to joining you in the short term for the next instalment of the NetWealth Portfolio Construction Podcast.
Thanks for listening to this episode of the NetWealth Portfolio Construction Podcast Series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.